Welcome to the Deep Dive. We're here to break down complex financial calls and really get you the key insights without all the jargon. Today we're looking at AZZ Inc. That's AZZ. Their second quarter fiscal year 2026 results. The call was back on October 9th.
Yeah, this was a really interesting one because, the market reaction was, well, it's pretty negative right off the bat.
Yeah.
Shares traded down.
Despite management sounding quite confident.
Exactly. Very confident, especially about the long-term picture. So our job today is to kind of unpack that disconnect. Why the focus on the short-term misses versus the underlying operational strength they talked about?
Okay, let's start right there. The headline numbers. Where did they land versus expectations?
Right. So revenue was $417.3 million. That's up 2% year over year. But like you said, it did miss the street's number.
Okay, and earnings per share.
Adjusted EPS came in at $1.55. That's up a decent 13% year over year. But again, just a bit shy of what analysts were looking for.
So two key metrics, both missing consensus estimates, albeit slightly.
Precisely. And that's what the market seemed to latch onto immediately. But, if you dig just a little deeper, the GAAP EPS, for instance.
Oh, right. That was huge, wasn't it?
Massive. $2.95. That's a 150% jump year over year. Now, granted, you have to factor in a big non-operating item there. That gain from the electrical products divestiture really skewed it.
Okay, so maybe not purely operational, but still a big number. What about core operations, like cash flow?
That's where it gets interesting. Operating cash flow generated was $58.4 million. That's up 23% year over year. Pretty strong.
Okay, generating good cash. And their debt situation.
Also looking healthy, they maintained a net leverage ratio of 1.7 times. So they're managing the balance sheet well, generating cash, even while they're investing.
Right. So misses on the top and adjusted bottom lines, but solid cash flow and a good leverage ratio. That really is a mixed picture.
It absolutely is. And it really boils down to the performance of their two main platforms, metal coatings and Precoat Metals. They're almost living in different economic worlds right now.
Let's break that down then. Start with metal coatings. That seemed to be the stronger one.
Oh, definitely the hero segment this quarter. Sales there hit $190 million. That's up almost 11%, 10.8% year over year.
And what was driving that growth specifically?
Management was very clear on this. It's infrastructure spending. Things like utility upgrades, solar projects, and especially transmission and distribution, or T&D, work.
So big multi-year projects often backed by government initiatives, less sensitive to interest rates, maybe.
Exactly. That's the key point. These are seen as having pretty durable demand drivers behind them. Now, there was a slight impact on margins.
Okay, what happened there?
Adjusted EBITDA margin for metal coatings was still really strong at 30.8%.
Right.
But it was down slightly, about 90 basis points.
And the reason?
They said it was a mix shift. Basically, more of that high-volume electrical and T&D work, which apparently carries slightly lower margins than some of their other business.
So maybe a conscious trade-off, securing that big infrastructure volume now, even if it slightly impacts the near-term margin percentage.
I think that's exactly the strategy. They're playing the long game, locking in share in these massive multi-year infrastructure builds, leaning into that certainty.
Okay, makes sense. Now let's flip to the other side. Precoat Metals. That was the weaker segment, right?
Yeah, that's where the headwinds were. Yeah. Sales, there were $227.3 million, which is down 4.3% year over year.
And what's causing the softness in Precoat?
It's pretty much tied to those cyclical end markets. Think non-residential construction, HVAC systems, appliances.
Yeah.
Areas that feel the pinch when interest rates are high or construction activity slows down.
So general economic slowdown hitting those areas. Anything else?
They also mentioned some customer hesitancy. Apparently, uncertainty around tariffs is making some customers, particularly for non-infrastructure projects, sort of wait and see before committing.
Okay. So with those headwinds, how did Precoat manage to, not fall further? Did anything offset the weakness?
They did point to a couple of things. One, they believe they actually gained some market share, partially helped, ironically, by those same tariffs reducing some imported competition, especially in things like aluminum cans for beverages.
Interesting. And the other factor?
The big one internally is the new facility in Washington, Missouri. It's starting to ramp up production volume.
Ah, the new plant. Is that expected to contribute more going forward?
Yes, significantly. They expect that ramp to continue strongly through Q3 and Q4. So that's a key internal catalyst they're counting on to help offset the broader market softness in Precoat.
Okay, that Washington ramp sounds critical for the second half. Let's shift gears slightly to their finances. They made some moves on their debt structure.
They did. some smart moves to lower their interest costs. They repriced their term loan B, basically got a better interest rate, saving about 75 basis points.
Okay, lowering borrowing costs, good move. And something about an AR facility, that sounds a bit technical.
Yeah, an accounts receivable securitization facility. It sounds complicated, but the idea is pretty simple. They set up a facility. This one has a $150 million limit where they can essentially sell off some of their incoming customer payments, their receivables, to get cash immediately.
Ah, so it frees up working capital faster.
Exactly. And they use the cash they got from that, plus the savings from the loan repricing, to pay down other more expensive debt.
Smart. What's the bottom line impact?
They figure it'll save them about $1.4 million in interest expense annually. So it's about financial discipline lowering their cost of capital.
Got it. And on the growth side, there was also a small acquisition, wasn't there, in Ohio?
That's right. A $30 million deal for a galvanizing business in Canton, Ohio. It's a bolt-on, added about $2 million in revenue in just 2 months.
Seems small, but they made a point about integrating it quickly onto their DGS system. Why is that important?
DGS is their digital galvanizing system. It's their proprietary software, their platform for managing the whole galvanizing process efficiently. Plugging Canton into it immediately means they can apply their best practices, optimize operations, and improve margins there right away.
So it's not just buying revenue, it's about integrating it into their efficient operational model. Shows a repeatable M&A strategy.
Exactly. It shows they have a playbook for buying these assets and making them more profitable quickly.
Okay. That operational focus definitely feeds into the guidance conversation. They kept the full year guidance, right?
Yeah.
Despite the Q2 misses.
It did. Full year sales guidance is still $1.625 billion to $1.725 billion. And adjusted EPS guidance is also maintained at $5.75 to $6.25 per share.
Holding firm. But there was a little bit of a nuance around the EBITDA guidance.
Yes. That's crucial. The adjusted EBITDA guidance range is still $360 million to $400 million,
Yeah.
but they specifically said they're now targeting the lower half of that range.
Okay, why the adjustment there? Was it performance?
Actually, no. It was more of an accounting and strategic shift related to their old Avail joint venture assets, the WSI business, lighting, stuff like that.
Right, the stuff they've mostly divested. So what changed?
Essentially, after selling the main electrical parts of Avail, they decided to just zero out any expected earnings contribution from the leftover Avail bits for the rest of the fiscal year, Q3 and Q4.
Wait, zeroing out expected earnings, doesn't that hurt the forecast? How are they still holding the overall EPS guide?
That's the key point. It signals a really significant strategic pivot. They used to rely on some income from those non-core Avail assets. By removing that expectation and still holding the main EPS guidance, they're basically saying, our core business, metal coatings, and the optimized Precoat is strong enough to make up for that lost income.
So it's a bet on the core operations, doubling down on coatings.
Absolutely. It shows real confidence in the organic growth and the efficiency gains they expect, especially for metal coatings.
That is a strong signal. What's giving them that confidence? What are the tailwinds they see boosting the second half?
It comes back to those big macro trends we touched on. U.S. reindustrialization efforts, the huge power demands from AI and data center build-outs, and the whole energy transition, solar, grid modernization. These are multi-year drivers.
And they feel these are sort of locked in.
They provided some compelling numbers, like 73% of the Infrastructure Investment and Jobs Act, IIJA funds, for transportation, and 77% of Department of Energy funds are already obligated to specific projects. This isn't just potential spending. It's money flowing into real work that needs their services.
So the demand pipeline looks pretty solid, especially for metal coatings. And they're not just waiting for it, they mention M&A too.
Yeah, they describe the M&A pipeline as robust. So they have 9 good opportunities they're looking at, mostly focused on adding more galvanizing assets that fit their model.
9 deals. That sounds ambitious. Is there a risk of, biting off more than they can chew?
It's always a risk with M&A integration, paying the right price. But their track record, like with that Canton deal getting plugged into DGS so fast, suggests they have a process they trust.
And why hasn't the market maybe rewarded that confidence more?
I think it comes back to the Precoat segment. Until investors see some stability there, or clear signs the Washington ramp is fully offsetting the cyclical weakness, they might remain a bit cautious, hesitant to fully price in that M&A potential and the infrastructure boom. But management sounded keen to get deals done before the fiscal year ends.
They also mentioned shareholder returns.
Right. Increase the dividend, and they started a $20 million share buyback program. Importantly, they're doing it through a 10b-51 plan.
What does that signal using a 10b-51?
It means the buybacks are pre-scheduled, automated. It takes day-to-day discretion away from management, which is good from a regulatory view, and it signals commitment. They see value at current prices and plan to return capital regardless of short-term market swings.
Okay, so pulling it together for you, the listener, this call really highlights that split, doesn't it? You've got metal coatings firing on all cylinders, riding that infrastructure wave, backed by a solid balance sheet, 1.7x net leverage.
But that's way down, at least in terms of near-term market sentiment, by the cyclical pressures hitting Precoat Metals. The market's watching if they can keep margins strong while integrating acquisitions and getting that Washington plant fully ramped up.
The really telling sign, though, seems to be management holding that full-year guidance.
Absolutely. Holding the line despite the Q2 misses and taking that Avail earnings contribution off the table. That screams confidence in the second half. They expect infrastructure spending, the benefits from integration, and that Washington ramp to really deliver.
What would be the trigger for upside, then?
Signs of life in those weaker Precoat markets. Any stabilization in construction, HVAC, non-res building, that could really boost sentiment.
All right. It's time for our segment, This Is Not Financial Advice, where we toss out a slightly adventurous but maybe plausible trade idea based on what we just heard. So the stock took a hit, trading around, $98, $99? But the company held its full-year guide. How could someone potentially play that disconnect?
Okay, let's call this the infrastructure leverage trade. The idea is to bet on the long-term, almost guaranteed infrastructure growth while acknowledging the market's current jitters about the cyclical Precoat side.
How do you structure that?
You want to leverage the strength in metal coatings and the positive impact of the debt reduction and those accretive acquisitions like Canton. The path to the high end of their guidance, that $6.25 EPS, looks pretty clear if that infrastructure demand keeps rolling in.
So you need time for that to play out and for maybe M&A to contribute.
Exactly. So instead of just buying the stock, maybe look at buying a deep-in-the-money call option. Give yourself some time, perhaps look out to early 2026 expiration.
Why deep in the money?
It gives you exposure with a bit less immediate time decay risk than an at-the-money option. The options market seemed interested right after the call there was action in the $115 calls for the near term. This trade just stretches that thinking out longer.
And the thesis is?
Simple. The combination of lower debt costs, guaranteed infrastructure spending flowing through, and accretive M&A will eventually push the stock valuation higher, reflecting that potential $6.25 in earnings. You're betting it breaks through resistance and maybe heads towards that $115 or $120 level eventually, long-term value overcoming short-term noise.
Okay, an interesting way to potentially play the long game there. So, to wrap up our deep dive, AZZ showed really strong execution in metal coatings, confirming that big infrastructure story is real.
But the misses elsewhere, driven by that cyclical weakness in Precoat Metals, definitely put a damper on the immediate market reaction. It creates this potential gap between current price and perceived long-term value.
And the final thought to leave you with?
It's really about the strategic bet management is making. They're consciously moving away from relying on income from those old Avail assets and betting everything on the core coatings business, growing it organically and through acquisition, powered by operational efficiency.
The big question is,
are those powerful tailwinds, the AI boom, solar grid upgrades, strong enough to completely overwhelm the traditional cyclical downturns in construction and do it faster than the market currently believes? That's the story to watch.
That's certainly the key tension. Thanks for joining us for this analysis of AZZ Inc.'s Q2 results. Hopefully, this gives you a clearer picture.